Listen, before you blink, something just happened that almost never happens in metals. Silver didn't just rise, it snapped into a new all-time high. Gold is breathing on $5,000, and Shanghai is trading way above the West. That gap isn't news. It's a warning. Because when East and West split like this, the next move can be violent, fast, and irreversible. And in the next few minutes, you'll see the one signal that tells you whether tonight ends with $100 silver or a brutal trap that wipes out late buyers. Stay with me, because the last 60 minutes before a breakout is where fortunes flip. Welcome back to Market Metal, where we cut through the noise and read what the market is really saying. Now let me ask you something. My respected legends over 50. If you've lived long enough to see prices double, banks fail, and experts change stories overnight, then you already know why you should subscribe right now. Because we don't chase hype, we track the signal. And tell me in the comments, from which city and country are you watching today? The signal of the market rarely sends breaking, silver surging. $97, $100 silver tonight. In the global financial system, true warning signals are rare. Markets move every day, prices rise and fall, headlines appear and disappear. Most of it is noise, but occasionally a number appears on a screen that does not belong to a normal trading environment. When that happens, experienced decision makers do not celebrate. They pause, they observe, and they ask what conditions made such a number possible. Silver approaching $97 an ounce is one of those numbers. For most of modern financial history, silver has lived in a narrow psychological box. $10, $15, $20, even $30 in past cycles was enough to generate excitement. But prices in the high 90s do not emerge from enthusiasm. They emerge when a market is under stress. They emerge when demand begins to outrun supply in ways that the financial structure was not designed to handle. From a statistical standpoint, silver trading near $100 is not a normal event. It places the metal into a category of price behavior that historically appears only near major monetary or industrial transitions. It suggests that forces larger than speculation are influencing the market. And those forces tend to move quietly, long before the public is aware they exist. Professional capital does not react to headlines. It reacts to signals. And silver at these levels sends a signal that the underlying system supporting this market may be changing. A normal price rally is driven by interest. A structural repricing is driven by necessity. Understanding the difference is critical. In ordinary cycles, silver rises because investors want exposure. They expect inflation. They expect a weaker currency. They expect rotation. Price increases attract sellers. Supply enters the market. The system balances itself. Structural moves behave differently. Supply does not arrive on schedule. Sellers hesitate. Buyers begin competing not on price, but on access. The market becomes thin. Spreads widen. Volatility increases. And price stops responding to news and begins responding to availability. The current movement in silver shows characteristics of the second type. As price advanced into the upper 90s, it did not slow the way a typical rally slows. It did not meet heavy, stabilizing supply. Instead, it accelerated. This is a subtle detail that matters, because when higher prices fail to attract new supply, it implies that much of the available metal has already been committed elsewhere. In such moments, price no longer reflects enthusiasm, it reflects scarcity. Psychological numbers like $100 attract attention, they dominate headlines, but professionals often focus on the levels just below them. These are the zones where pressure builds quietly, where leverage concentrates, where institutions test liquidity without alerting the broader public. $97 is one of those zones. At these levels, silver begins to behave less like a trade and more like a strategic material. The questions around it change. Instead of asking, will the price go up? Participants begin asking, will supply still be available if I wait? This shift in thinking is one of the earliest markers of a market leaving the speculative phase and entering the allocation phase. Another important detail lies in who is driving the movement. Retail participation creates noise. It creates volume. It creates short bursts of volatility, but it rarely creates sustained structural pressure. Retail traders do not take delivery of large quantities of metal. They do not lock in multi-year supply. They do not drain distribution channels. Institutional and industrial participants do. Their influence is seen not primarily in news articles, but in how markets behave, in how quickly dips are absorbed, in how futures curves distort, in how regional prices diverge, and in how inventories change quietly without publicity. As silver approached these levels, it showed signs of being supported beneath the surface. Pullbacks became shallow. Selling waves struggled to follow through. The market behaved as though significant buying interest existed below visible liquidity. This pattern often appears when long-term participants are active. Participants who are not concerned with capturing short-term price movement, but with securing future access. This distinction matters deeply to business leaders and capital allocators. Speculative markets reverse when sentiment changes. Structural markets reverse only when supply conditions change, and supply conditions change slowly. Silver occupies a unique position in the modern economy. It is not only a monetary metal, it is also an industrial necessity. It is embedded in electronics, energy systems, data infrastructure, and advanced manufacturing. Much of the silver consumed each year does not return to the market. It becomes dispersed. It becomes embedded. It becomes unrecoverable at scale. This creates a system where availability, not interest, ultimately governs behavior. The central strategic question is therefore not whether silver can touch $100. The more important question is what the market is revealing about itself by approaching that level. Historically, when silver has entered rare price territory, it has often done so during periods when financial structures were under revision, when currencies were under strain, when industrial demand was rising faster than extraction, when debt systems were expanding beyond productive capacity. In those periods, silver did not rise smoothly. It rose in phases, long periods of compression, sudden expansions, violent consolidations, and then repricing events that redefine the perceived value of the metal. Such episodes are not remembered for their peaks. They are remembered for what followed them. When a market moves into territory where historical reference points become scarce, risk models weaken, behavioral assumptions fail, and institutions begin relying more heavily on real-world procurement data than on financial projections. That is where silver now stands. This is why experienced observers are less focused on whether $100 prints tonight and more focused on what is happening beneath that number, because markets rarely announce structural change. They signal it, and silver in the high 90s is not whispering. It is warning. The physical market. Beneath the screen, most people believe markets exist on screens. They see numbers, charts, candles, percentages. They assume these things are the market, but professionals know the truth. The screen is only the reflection. The real silver market lives elsewhere. It lives in vaults, in refineries, in shipping manifests, in industrial contracts, in delivery notices that almost no one reads. It lives in the quiet systems that move metal from the ground into the global economy. And when silver begins to surge the way it is now, the first place serious observers look is not price. They look at whether the metal itself is becoming harder to obtain, because there are not one, but two silver markets. The first is the paper market. This is the market most participants interact with. Futures contracts, options, exchange-traded products. These instruments represent silver, but they are not silver. They are promises, claims, accounting units designed for liquidity, not delivery. The second is the physical market. This is the market where silver must be dug, refined, transported, insured, stored, and delivered. This is the market governed by logistics, geology, and industrial schedules. This is where constraints exist. This is where stress reveals itself. Most of the time, these two markets move together. But during structural change, they begin to separate. And separation is exactly what professionals have been watching. In the paper system, a single ounce of registered silver can support dozens, sometimes hundreds of financial claims. This structure works only if the vast majority of participants never ask for the metal. It is designed around settlement, not extraction. Under normal conditions, this poses no visible problem. Under stressed conditions, it becomes dangerous. Because when enough participants shift from trading price to seeking delivery, the system must suddenly operate as a logistics network instead of a financial abstraction. That transition is never smooth. One of the earliest warning signs appears in something few retail traders ever study: the futures curve. In a balanced market, future silver is priced higher than present silver. This reflects storage, insurance, and financing costs. It implies confidence that supply will remain available. But when near-term silver begins to trade above future silver, the market enters a condition known as backwardation. Backwardation is not an opinion. It is not sentiment. It is a signal. It means buyers are willing to pay more to secure silver now than to promise payment later. It means immediacy has acquired value. It means availability is becoming a variable. This condition does not occur in surplus markets. It occurs when users begin to doubt that supply chains will function smoothly. Alongside this, professionals monitor lease rates. These are the cost institutions pay to borrow physical silver. When lease rates rise, it suggests that vaults are less willing to part with inventory. It suggests that metal is being reserved, not circulated. At the same time, physical premiums across global trading hubs quietly widen, not because of retail excitement, but because distributors must compete for fewer available bars. This behavior rarely appears in headlines, but it changes how procurement officers act. And procurement officers do not chase trends, they secure survival. Another fracture line has been emerging between regions. Under normal conditions, silver prices across major markets remain tightly linked. Arbitrage ensures that discrepancies are short-lived. If silver trades higher in one region, metal flows there until the difference closes. But this system depends on free metal. and free metal depends on excess inventory. When silver in Eastern markets begins to hold persistent premiums over Western exchanges, it signals that arbitrage is struggling, that moving metal fast enough to satisfy demand is becoming difficult. This is not theoretical, it is mechanical. It means refineries are booked, shipping schedules are tight, warehouses are reluctant, and buyers are no longer waiting for paper contracts to settle. They are seeking confirmed access. This is where price begins to change character. Instead of moving on news, it begins moving on logistics. Instead of reacting to opinions, it begins reacting to inventory. This is why sudden price expansions in metals often confuse the public. They appear to come out of nowhere. In reality, they come from months of invisible strain. Silver occupies a particularly fragile position in this system. Unlike gold, most silver is not mined for its own sake. It is produced as a byproduct of other metals. This means silver supply does not respond well to silver price. A copper mine does not double production because silver rises. A zinc operation does not pivot output to satisfy solar demand. Supply is slow, but modern demand is not. Silver is consumed in energy systems, electronics, medical technologies, and advanced manufacturing. Much of it is used in tiny quantities, spread across billions of devices. Once deployed, it is rarely recovered. This creates a one-way flow, from vault to factory, from factory to product, from product to dispersion, and dispersion is permanent. When such a market begins to tighten, the first visible stress appears not in headlines, but in behavior. Traders begin paying up for immediacy. Institutions begin reducing willingness to lease. Manufacturers begin securing longer contracts. And exchanges quietly report changes in inventory classifications. These are not the actions of excitement. They are the actions of preparation. This is what gives the current silver movement its strategic tone. The question professionals are asking is not whether momentum traders can push silver through $100. The question is whether enough physical silver exists at accessible nodes of the system to satisfy both financial settlement and industrial continuity. Because when those two demands begin to compete, price is no longer the primary regulator. Allocation is. And allocation is never emotional. It is administrative. It is contractual. It is enforced by necessity. Which is why markets do not panic at first. They reorganize. And silver's recent behavior suggests that a reorganization may already be underway. Not on screens, but in the places where silver actually lives. The supply wall, nobody can scale. Every market ultimately answers to one force. Not sentiment, not charts, not forecasts. Supply. Silver's current surge cannot be understood without confronting a reality most market participants rarely study. Silver is not a flexible commodity. It is not oil. It is not corn. It is not software. It cannot be scaled quickly. It cannot be manufactured. It cannot be innovated into existence. It must be found. And finding it has become harder every year. For decades, silver supply has rested on an assumption that no longer holds. The assumption was that if demand ever truly surged, the mining industry would respond. New projects would come online. Production would rise. Balance would return. But that assumption belonged to another era. Today, silver mining operates inside some of the longest, slowest, and most capital-intensive pipelines in the global economy. From discovery to commercial production, a new mine often requires 10 to 15 years. That timeline includes exploration, feasibility studies, permitting, financing, construction, and infrastructure development. Each stage introduces delay. Each stage introduces political risk. Each stage introduces the possibility of cancellation. Rising price does not compress these timelines. It collides with them. Even more critically, silver is rarely mined for silver. Roughly 2/3 of global silver production comes as a byproduct of copper, zinc, lead, and gold mining. This structural detail is decisive. It means silver supply is not controlled by silver demand. It is controlled by the economics of entirely different metals. If electronics and energy markets require more silver, that does not automatically increase silver production. It increases strain on a supply stream that was never built to respond to silver. A copper producer will not double output because solar manufacturers need silver paste. A zinc operator will not accelerate permitting because battery factories require more silver components. Silver is trapped inside other industries, and those industries are not built for agility. This is why professional commodity analysts often describe silver as one of the least responsive supply systems in the modern resource economy. It does not stretch, it does not bend, it resists. For years, this resistance has been masked by above-ground stockpiles. When mine output failed to match consumption, inventories absorbed the difference. Government reserves, exchange warehouses, private hoards, industrial buffers. These pools allowed the system to appear balanced even as it quietly ran deficits. But stockpiles are not production, they are inheritance. Once drawn, they are not easily replaced. Over the past decade, silver consumption has increasingly exceeded annual mine supply. The gap has not been catastrophic, but it has been persistent. And persistence matters more than magnitude, because persistent deficits transform inventories from buffers into targets. They are no longer insurance, they are supply. This shift alters behavior across the entire chain. Refineries shorten delivery windows, distributors reduce standing inventory, industrial users lock longer contracts, financial holders become more reluctant to lease metal. These actions are not public, they do not generate headlines, but they change the physics of the market. At the same time, the mining industry faces a problem that price alone cannot solve: the quality of what remains. Ore grades across much of the world have been declining. Deposits are deeper, more complex, more politically exposed, more environmentally constrained. Each ounce now requires more energy, more capital, more regulatory negotiation, and more time. This increases the marginal cost of production, but more importantly, it reduces the speed of expansion. The modern silver supply chain is not built for shock demand. It is built for continuity. That is why sudden global demand increases rarely produce gradual responses. They produce strain. Another assumption often invoked during tightening markets is recycling. Recycling exists. It contributes meaningfully, but it is not elastic. It depends on consumer behavior, industrial scrap flows, and processing infrastructure. It rises slowly, and it cannot replace dispersed metal embedded in billions of small devices. Recycling responds to years. Markets respond to months. This mismatch is where suspense enters the system. Because once readily available above-ground stockpiles thin beyond operational comfort, the market is forced into a new regime, one where access, not price, governs activity. This is when competition changes character. Industrial buyers begin prioritizing continuity over cost. Institutions begin reducing exposure to settlement risk. And financial structures built for abundance confront scarcity. It is in these moments that metals stop trading like assets and start behaving like infrastructure. And infrastructure shortages are never linear. They unfold quietly, then suddenly, then everywhere. Silver's recent behavior suggests that the supply wall is no longer theoretical. It is being touched. The surge toward the high 90s is not simply a reflection of speculative enthusiasm. It is occurring alongside conditions that imply the system is testing its own limits, that participants are probing how much metal is actually available without disruption. This is not the final phase of a cycle. It is the transition between models, between a market that assumed surplus and a market that must now price constraint. Such transitions rarely announce themselves. They reveal themselves through stress, through acceleration, through behavior that no longer fits historical patterns. Silver's acceleration toward rare price territory is not important because of the number. It is important because it suggests that the wall is being approached, and walls do not negotiate. They either hold or they force reconfiguration, which leads to the final question facing capital, industry, and strategy. What happens when a market built on abundance must operate under limits? That answer lies not in the past, but in how capital now begins to move, capital rotation, and the risk of being late. When markets approach levels they have not occupied in modern memory, attention naturally concentrates on the number itself: 98, 99, 100. But experienced decision makers rarely fixate on the number. They focus on the behavior around it. Because major price levels do not create transitions, they expose them. Silver's movement into the high 90s is not merely a commodity story. It is a capital story. It is a reflection of how institutions, corporations, and sovereign actors behave when confidence in financial continuity begins to thin. Throughout modern economic history, periods of rising systemic stress have followed a familiar pattern. Capital first seeks yield, then it seeks growth, then it seeks safety. Finally, it seeks reliability. Reliability is not a return metric. It is a survival metric. This is the phase where capital stops asking, how much can this earn? And begins asking, will this still function? Silver sits precisely at that intersection. Unlike gold, which primarily expresses confidence or doubt in monetary order, silver operates inside the physical economy. It is not merely held, it is consumed, it is fabricated, it is embedded into the mechanisms that make modern infrastructure possible. When capital begins to allocate towards silver under conditions of structural strain, it is not expressing optimism, it is expressing dependency. This is why silver historically lags gold early in monetary transitions and then accelerates violently later. Gold attracts hedging, silver attracts necessity. When industrial and technological systems expand, while financial systems destabilize, silver becomes contested, and contested assets do not rise smoothly, they reprice. One of the most revealing signals during such phases is the behavior of commercial participants. Producers, fabricators, and large users behave differently from traders. They do not speculate on peaks. They secure flow. When they perceive risk to continuity, they extend contracts. They reduce exposure to spot markets. They accept higher costs in exchange for guaranteed access. These decisions are invisible to most observers, but they alter the supply environment for everyone else. At the same time, financial institutions begin managing a different risk, settlement risk. When futures markets grow thin relative to deliverable inventory, leverage becomes fragile. In such environments, price volatility is not merely market noise, it is system testing. Every sharp move probes whether the structure can still clear. This is why the most dangerous period in any commodity cycle is not the crash phase. It is the disbelief phase, the period where prices move far enough to invalidate old assumptions, but not far enough to force new ones, where participants still frame behavior through outdated models, where they assume reversion because reversion has always occurred before. But structural markets do not revert until the structure changes. They persist until new supply is built, new demand is destroyed, or the system reorganizes itself around new constraints. Silver's current behavior places it firmly inside this zone. The approach toward $100 is psychologically dramatic, but strategically, it is only a marker, a reference point around which capital psychology shifts. Above such levels, institutions are no longer anchored by past ranges. They must assess exposure from first principles. How much silver is required, how much is secured, how much is floating, how much is replaceable. This process often triggers rotation. Funds reweight, corporations hedge differently, procurement strategies adjust. And portfolios that once viewed silver as a minor allocation begin reassessing it as a functional input. These shifts are not synchronized. They cascade. One balance sheet moves, then another, then a third. And as they do, they remove metal from availability. This creates a feedback loop. Reduced availability increases urgency. Urgency accelerates